All right, good afternoon, everyone, or good evening, or good morning, or whenever you're watching this video. It looks like this is going to be the new future of personal finance. Woohoo! I hope all you guys are staying in, staying healthy, practicing social distancing, etc., etc. Before we get started with this, there are a couple of quick updates that I want to give you guys. This is at 18 or 8:18 on March 17th. Um, so I don't know if anything is going to be changing from now kind of in the future, if UNCC will send out another update or not. But as of right now, here's what they've said. All classes, including labs, are going to be online or remote for the remainder of the semester. So you guys don't have to worry about coming back to campus. If you guys do live in like a residence hall, you are going to have to leave by no later than 5 p.m. this Friday, on the 20th. You can apply for an exemption through the Housing and Residence Life. I don't know what that looks like, if there's an online application or what that is gonna look like. So if you guys do need to stay on campus for whatever reason, I would go and I would contact them. As far as refunds for housing and dining fees, they're not going to discuss that at least until April. And if any of you guys are graduating seniors, which I don't think anyone in this class is, but if you have friends who are, there's been no update on what graduation is going to look like, what their decisions are. My guess is that the university is still just trying to monitor this ongoing situation and see kind of where things are going to go. It looks kind of like every single day something is changing and there are new updates, and we're all just trying to figure everything out. Like, for example, recording this PowerPoint and uploading it to YouTube. I've never done this before. This is brand new to me, so we'll just kind of have to figure out as we go along. So that's all the updates I have for you. Again, as of 8:18 on March 17th, if something changes in the future, please be aware of that. Please check your emails, check Twitter, check Niner Alert. Just stay updated. So what we're going to learn about today is we're going to talk about banking. What services are offered at banks, kind of how banks can help you manage your money, etc., etc. So as we talked about last class, routinely spending cash requires some type of plan. Making sure that you guys have your cash flow statements and comparing that to your budget, always trying to have a surplus, knowing your net worth, your assets, your liabilities, all of those things. And when you do regularly spend money, which almost all of you should do, or which I'm sure all of you guys do, cash, checks, credit cards, debit cards, online, mobile transfer are all common payment choices that you guys have to sort of keep your plan intact and make sure that you are keeping up with your payments, and that if you have any kind of fixed expenditures like rent, you are always paying that on time. The most common mistakes that people make when managing current cash are, number one, overspending. So like, for example, if you constantly go out to Starbucks or you overbuy at the grocery store, something like that, as well as having insufficient liquid assets to pay any of your current bills. So for example, if you fall and you break your leg and you get a bill for $5,000 and you don't have $5,000 in your account, that's going to be a problem. As well as using savings or borrowing to pay for any kind of current living expenses, as well as failing to put leftover funds in any type of interest-earning savings account or investment. And no matter how carefully you manage your money, at some point in your life, you are going to need more cash than you're going to have available. The best example that I can give is like buying a house. Houses, usually cost $250,000, $300,000, $350,000. And unless any of you guys have $300,000 burned a hole in your britches, you're not going to be able to buy a house in cash. And if any of you guys do have $300,000 just chilling in your pocket, let me know and we can be friends. But in that situation, when you do need more money than you have in your liquid accounts, like in savings or checking account, you pretty much have two choices. You can start to liquidate everything, or you can borrow money. Just keeping in mind that using both savings and increasing your borrowing is going to reduce your net worth, and it could potentially limit you in your long-term financial security and prevent you from achieving your financial goals, whatever they are. And this is where a financial institution like a bank is going to be able to help. When you want to make a big purchase like buying a house, typically it's better to borrow than it is to liquidate. My personal advice to all of you guys is that when you are ready to buy a house, whenever that might be, that you just go to a bank and you get a mortgage. It is going to be a hassle to set up. There's no doubt about it, but it's better to borrow money and still have some type of money in liquidity. Um, because if you I'm sorry, I'm trying to figure out a way I can phrase this to kind of make you guys understand. When you buy a house just in cash, that kind of ties up all your available cash. So let's say that you did have $300,000 and you went out and you bought a house for $300,000 just in cash, and then you were walking outside in your driveway, you fell down and you broke your leg. And now you have a bill for $5,000 from the hospital because you broke your leg. All of your money is going to be tied up in your house, and you're not going to be able to get any of that money unless you sell the house, which is going to be a really big process because you're going to have to get a real estate agent. There are going to be fees. People have to come look at it, et cetera, et cetera. You always want to have money in liquidity in like a savings account or a checking account. But to help grow and sort of protect your money, banks and other financial institutions can offer services in sort of four main categories. Not only with borrowing, but also with being able to grow your savings, grow your liquidity. So, for example, if you do want to go out and buy a house, you kind of show the bank that you can put up some money along with them, or you can just show them you do have the ability to pay back money that you are asking for. You know, banks don't like it when you want to buy a house for $300,000 and you'll never be able to pay that back because then that's just a loss on the bank. So the very first service that a financial institution like a bank is going to offer is number one, savings. Savings are a place to put money for future use. It's not money that you're going to want to use right now, but it is liquid money that you want to set aside. These are also called time deposits, and they earn money in savings account as well as certificates of deposits or CDs, which we'll actually talk about a little bit later in this PowerPoint. Each will offer sort of their own rate of interest, available liquidity, safety, convenience. So when you're thinking about setting up a savings account or some other type of deposit, make sure that you just ask your bank or your banker, whoever you're working with, what kind of options they offer, and start making some comparisons and just kind of think about maybe what's best for you, what's best for your family, what's best for your financial needs. The second type of service is cash availability as well as payment services. This is the ability to transfer money to others that's a typo. Oh, no, it's not. The ability to transfer money to others is a necessary part of daily business activities. Sorry, everyone. So this is pretty much always going to take a form of like a checking account or other type of payment methods called a demand deposit. And the idea is that it's just money that you're going to want to use right now or money that you plan to use in the very near future. So, for example, if you know that rent is $800 for April, maybe you want to go ahead and set aside that money in your checking account or in your demand deposit so that you have that money ready for when that bill comes in April and you can just kind of pay off your rent. As a quick note to everyone, side note, I cannot reverse slides in this mode. So if you kind of got confused on something, you weren't done taking notes, you're just going to have to pause me and kind of rewind yourself. I can't really go backwards. I don't understand why. I guess the makers of Microsoft, in their infinite wisdom, just didn't think that was important. So the third service that a financial institution is going to offer is borrowing. Most of the time, excuse me, when you borrow, you have to borrow on credit. And we'll talk a little bit more about credit later I think it's maybe in the next couple of modules we'll actually get to credit. You guys can check your calendar and see exactly when we're going to get to it. So credit alternatives can range from very short-term accounts, things like credit cards and kind of cash loans for a bank, as well as to long-term borrowing, such as a home mortgage. Typically for long-term borrowing, like a mortgage, you are going to have to pay back interest on your loan. So say, for example, that you want to buy a house for $250,000. So you go to the bank and you get that loan for $250,000. Well, over the next 15, maybe 30 years, you might actually end up paying back $300,000 to the bank. And that's just another way that a bank can get money. For very short-term loans, like a credit card, for example, you really don't have to pay any interest rates unless you fail to pay back the money within the time that you guys agreed upon. So, for example, I have my credit card with Wells Fargo. Wells Fargo says that I have to pay off my credit card every single month. So if I put $100 on my credit card, I need to make sure that I give Wells Fargo $100 by the end of the month. If I don't, then they will put interest on my credit card, and it's typically going to be a very, very high interest rate. I don't know what mine is specifically on my card, but I know that sometimes it could be like 20, 25, maybe even 30%. So whatever 30% of however much money you have left on your credit card is going to be added straight back into your bill. And again, that's another way that banks can make money, and that will actually hurt your credit score. But typically, as long as you're making those payments on time for a short-term loan, short-term borrowing, you're not really going to have to pay any interest. There are also types of investments that you can make at a bank, as well as other financial institutions, like a mortgage company, a investing company, for example, which we'll talk a little bit about later. So insurance, investing in stocks, real estate purchases, and financial planning are all additional services that you may need for financial management. So being able to talk to a banker about what your needs are and kind of what your goals are and where you want to move in the future. So a trust is a legal agreement that allows one party to manage and control assets for you. This type of agreement is most commonly created through a bank or through a lawyer. Typically, when you hear about trusts, you mostly hear about it in the forms of parents leaving some type of assets to their children. If you guys have ever heard the term like trust fund baby, this is kind of where that comes from. Trust doesn't necessarily have to be between a parent and a child. It can exist in almost any situation, but 9 times out of 10, that's really where you're going to hear about it most. A trust isn't necessarily something that everyday people like you and I are going to use. Typically, if you're a lot wealthier, maybe if you went out and you became the next Jacob Fugler, for example, and had $500 billion, you might kind of want to think about setting up some type of trust account. But if you're an average everyday Joe, it may not necessarily be something you need, but it is something you could talk to a financial planner about, and they'll be able to give you some advice. Excuse me. So to simplify this sort of wide range of financial services and attract customers, some financial institutions are going to offer these all-in-one accounts called asset management accounts. They'll also call it like a cash management account. And it typically provides complete financial services for a single fee, and it includes a checking account with an associated debit card, online banking, a mobile app, as well as a line of credit that you can use. So, for example, like a credit card, or being able to get a mortgage through them. These accounts will also provide access to stocks, bonds, and mutual funds, and other types of investments that we will talk about a little bit later in this course, so that you're able to grow your money over time. I personally don't recommend an asset management account. It can be very, very simple, but a lot of times those fees can be really, really high, and a lot of times there are like very hidden fees with them. And to me, I just like having my accounts separate. So for example, my investments in the stock market, I like to have them separate in my checking account than in my savings account. Because if you kind of have this sort of all-in-one account, if your money goes into the stock market and the stock market crashes, like for example, on Monday, March 16th, the Dow, I think, dropped, it might have been like 3,000 points almost. Then that's going to be a huge, huge hit to all of your money in that account. So I think it's better to sort of diversify and not really put all of your eggs in one basket. There are some upsides to it. I have listed down there, being able to keep track of your money in a single location. There are fewer statements that you have to deal with. So, for example, when you are making your cash flow statement, you're not going to have to look at your credit card statement and your bank statement and your statement from this account and that account. It is all just one statement. And typically, the larger your balance is, the lower your fees are going to be, because the larger your balance is going to be, the more money it's going to make a financial institution like a bank or some other type of investment firm. So for online banking is probably something that most of you guys use already. It's very, very simple. You can have apps on your phone. I have the Wells Fargo app on my phone. I use it all the time. I use it to pay off my credit card. I use it to transfer money to people that I need to transfer money to. It's very, very popular, and I think over time it's going to be one of the most popular forms of being able to exchange money. The more traditional way to exchange money or make deposits or transfer money is through an automatic teller machine or an ATM. Sometimes people call it a cash machine. I've never heard it called that, but apparently your textbook says people call it that, so who knows? So being able to use your debit card, you can make cash withdrawals and deposits into your account. The downside is to this is that banks typically have their own personal ATMs. So, like for example, there's a Wells Fargo ATM and a Bank of America ATM. There's a Citibank ATM, and if you use an ATM that's not associated with your specific bank, they will take a small fee. So, like for example, the other day I was over at the DMV getting a new license plate, and I needed some cash, and I didn't have any cash, and so the woman directed me to this Bank of America ATM that they had that I would be able to withdraw cash from. Now I'm not a Bank of America customer. I bank with Wells Fargo, and so when I did take out money, I took I think a $5 or $6 fee out of my account. So it's not really the best thing, or it's not recommended to use ATM machines that are not associated with your specific financial institution. Keeping in mind also that your debit card is not the same as your credit card. Your debit card is going to be like using cash, as whereas a credit card means that you're borrowing short-term money and paying that back. So make sure that you guys know the difference between a debit card and a credit card. And when we talk more about credit, I'll talk about this difference a little bit more and what a credit card actually means. So when you are looking at financial institutions and financial services, you want to be able to consider your opportunity costs and your trade-offs. Current satisfaction versus long-term financial security, for example. So think about kind of like what you give up when you select and use a financial service. So for example, if you want to have an all-in-one account, that's perfectly fine. You can do that if you think that's best, as long as you're okay with giving up some type of security that's associated with that. Versus maybe you want to put all of your money into a savings account and you don't want to have an all-in-one account. Well, your opportunity cost for that, what you're giving up, is the possibility for a higher return. You're going to have more statements. Creating your cash flow statement might be a little bit more difficult, et cetera, et cetera. I have an example down here. You can get higher returns over a long period of time in the stock market. And we talk more about stocks. I'll talk about how you can make money, and really you can make a lot of money in the stock market, as long as you're sort of in it for the long haul. But when you do put money in the stock market, you do run risk. So, for example, the stock market could crash like it did on Monday, and you could lose all of your money. And also, I would not consider money in the stock market to be a liquid asset like it would be in a savings account, because when you take out money from the stock market, um, you are going to have to pay taxes on it. So, for example, if you put $500 in Apple and then you took it out and that same $500 was worth $1,000, the government's going to say, oh, well, that's income, and they're going to take a piece of that. Your stockbroker or whatever service you use to make that investment will probably also take a little chunk out of that. And so maybe you're really only left with like $700 or $800. Changing interest rates, rising consumer prices, other economic factors can influence what type of choices that you want to make at a financial service. So, for example, let's say you want to buy a house and you want to borrow $300,000. Wells Fargo might offer an interest rate on that $300,000 loan at 5%. But then you can go to Bank of America and they might say, well, we'll give you this exact same amount, $300,000, 30-year mortgage, but we'll only charge you 4%. And even though that's only like a 1% difference over the next 30 years, that could be really significant. So the different types of financial institutions that you might encounter. So number one is a commercial bank. This is going to be your typical Wells Fargo, Bank of America, Citibank that you see pretty much everywhere. They're going to offer a very wide range of services, including checking, savings, lending. You can get your own mortgage through Wells Fargo, through Bank of America, et cetera, et cetera. Banks are corporations. They do have investors and they do have stockholders. And their job is to sort of contribute the funds needed that the bank needs to operate. Versus a credit union. A credit union is user-owned, it's nonprofit, and it's a cooperative financial institution like a bank. So typically, members of a credit union have to have some type of common bond. Like for example, a type of work I have done here on the screen, the teachers credit union, for example. It could also be a shared race. So I think over on Monroe Road, close to this intersection of Idlewild and Rama, there is like a Hispanic, or it might be a Latino credit union. I'm actually not sure. But that could be an example of a credit union or a community affiliation. So maybe there's like a South Charlotte credit union or a University of North Carolina at Charlotte credit union. I don't actually know. But today, credit union memberships are a little bit more flexible, they're a little bit more fluid, and they're not as rigid as they once were. So the good thing about credit unions is that fees and loan rates are typically lower. And when you compare satisfaction rates to commercial banks, people are typically more satisfied with a credit union. I personally recommend if you're deciding between a credit union and a commercial bank, you go with a commercial bank. Um, Commercial banks are much larger and they may not have the best type of customer service, but I think that you get better security at a commercial bank. And if you're somebody who likes to travel a lot, you like to go a lot of different places, then your money or your card that you have through a commercial bank is more likely to be accepted. So, for example, in the summer of 2018, UNCC gave me a bunch of money to go to London for 10 days and do research for my thesis. While I was there, I had my Wells Fargo debit and credit card, and pretty much everywhere I went, banks accepted it. I did have to pay a certain fee because I was using it out of the country, and then the United Kingdom doesn't use American dollars; they use British pounds. So there was two fees I had to use. So number one for using a foreign country, and number two for kind of converting the British, or I'm sorry, from converting American dollars into British pounds. But all in all, it was actually pretty easy. Versus if you had a card from a credit union, like for example, a teacher's credit union, a place in London may not accept that, and it's something that you're going to want to have to consider. If you're leaning more towards a credit union or you think it might be a good idea, it's something that you could possibly talk to a credit union representative about. There are also mutual savings banks. And instead of shareholders, a mutual savings bank is going to be owned by its depositors, much like a credit union. However, unlike a credit union, a mutual savings bank is going to operate to create profit for its shareholder members. So you can kind of think of a mutual savings bank as a for-profit credit union. Mutual savings banks are typically more found in New England. They're not very prevalent here in the South, but if you're interested in like maybe moving to New York one day or Maine or Boston even, like for example, Mary calling you out, you might be interested in going to a mutual savings bank. Just make sure that when you go there, you kind of ask the representative about the different services that they offer and get an idea of what they can offer you versus what a credit union or a commercial bank can offer. There are high cost alternatives to banks. There is no law in the world that says you have to operate with a bank. You can also get a payday loan. However, payday loans are extremely dumb ideas. Do not ever get a payday loan unless you are out of options. This service is going to offer a short term loan at a ridiculously high interest rate, sometimes high as 780%. The most frequent users of payday loans are actually workers who have become trapped by debt. And when we talk a little bit more about the cycle of debt, when we kind of get into credit, we'll talk a little bit more about payday loans. Do not ever go to a payday loan. It is, I don't want to say it's a scam because it's perfectly legal, but it is a way. Once you start getting that cycle of a payday loan and you get trapped in that cycle of debt, it's very, very hard to get out. You also have what's called rent-to-own centers, and rent-to-own industry is I think it's kind of like also like a scam. I mean, it's not really going to be worth it. Uh, so what happens is that for the rent-to-own industry, they offer stores to lease their products to customers who can own the item if they complete a certain number of payments. Uh, but those payments are going to be ridiculously high. Annual interest rates I have down here could be over 300%. And so if you want to buy a $600 computer, you could end up paying $1,900 for that computer. And in my opinion, it's better to just wait until you have $1,900 or even less than that. Get a $1,000 or a $400 computer and be able to just buy that in cash rather than going to a rent-to-own center. Um, rent-to-own centers are really, really common in the South. Like when I lived in South Carolina, I saw them all over the place. They're really dumb. Don't ever do it. Don't do it with a computer. Don't do it with a house like this couple did down here. They look really happy right now, but I promise you that in the next year or so, they're going to be very, very unhappy. Other type of financial institutions, or I'm sorry, so some banks could also offer a money market fund. And a money market fund is a combination sort of savings and investment plan. The company, whatever you choose, if it's a commercial bank or a credit union or whatever else, is going to take the money that you deposit into account and make very short-term investments. And when I say short-term investments, it could be as short as a couple of hours. It could be as short as a couple of days. A lot of times this could happen overnight and money returns to your account the next day. While you do kind of get that sort of liquid availability with it, you do also kind of run the risk of losing all your money because investments can always turn sour, investments can always go downward, and you can lose your money in any other investment. And unlike checking and savings accounts, the money in a money market fund is not going to be insured by the FDIC or the Federal Deposit Insurance Corporation. This federal program is sort of a legacy of the Great Depression when a bunch of banks failed and people lost all of their money. So what this federal program will do is that if your bank fails, the federal government will return up to $250,000 of your money per account per institution. So if you have $300,000 invested into an account and your bank fails, you're going to get back $250,000. As for the other $50,000, you can consider that a donation. Only you won't be able to actually write it off your taxes. So, when you're comparing financial institutions, so step number one is just learn about the important features that different institutions offer. So, and think about kind of what's important to you. I mean, do you really want to have a mobile app? Because maybe a credit union doesn't have a mobile app, but a bank or a commercial bank will. Think about what's important to you. Think about the different services that are offered, and just start listing them out. And think about, for step number two, you want to rank them. So see kind of where they rank. Think about what features are important to you, what institutions offer those features. Think about your opportunity cost. Just think about what's important to you and think about what they offer. Make sure that you do your research, make sure that you collect your information, and it's also okay to just kind of call or shop around. You can just call Wells Fargo and talk to a representative and see the type of services that they offer. They are going to try and sell you on something. They're going to try and get you to open an account that day. But all you really need to say to them is, thank you for your time. I'm still looking around, and if I have any more questions or if I'm ready to open up an account, I'll give you a call. And then hang up and call Bank of America and repeat that whole process over again. You have to remember kind of you're the catch in this situation. Banks are going to want you to bank with them, and you can be picky about it, and please be picky about it. Think about what you want, think about what banks offer, or maybe some sort of not bank institution, and just kind of see how they rank. Actually, I'm going to go ahead and skip over this slide. So for a savings plan, when you are creating a savings plan, think about the different sort of saving options that banks have. So for example, your standard basic savings account, which we've already sort of talked about, you can put money in there that you don't immediately need. It will accrue interest over time. And it's kind of like free money that the bank is sort of offering to you. You can also get a certificate of deposit from the bank. And a certificate of deposit, or a CD, is a savings plan that is going to offer you an extremely high return. The only downside to this is that it's going to be very, very low liquidity. So for example, I have up here an example. So you deposit $10,000 into a certificate, or you give the bank $10,000 and you get a certificate of deposit back. After the very first year, you can see that, can I draw on this? Oh, I can. So you can see that kind of moving down here, after that very first year, you get $400 back. So that's $400 interest, and you don't accrue any penalties if you decide to withdraw early. So the next year, by year two, you have $10,816, but you do have that, or I'm sorry, you don't have any penalty, and congratulations, you just got more interest. And it keeps going and going. At some point, if you want to withdraw early, you may have to pay a penalty. So, for example, this right here says that if you withdraw after 3 years, you do have to pay the bank a penalty of $108. So it does tie up your money for a certain amount of time. I have up here, it can range from 30 days all the way up to 5+ years. But it does offer a very high rate of return. So for example, if we're looking right up here, let me change the color. Ooh, let's go with purple. So you can see that here you started out with $10,000, but after 5 years, that same $10,000 is now going to be worth $12,167. So that is, let's change the color one more time. Let's go orange. So you can kind of think of this as like you made $2,167 just by putting your money with a bank, and that's not money that you had to work for. You didn't have to go for a job or go to a job. You didn't have to listen to a boss. You got to just kind of sit on your rear end and collect some money after 5 years. A money market account is a type of savings account that requires a minimum balance and has earnings based off of market interest. It's very similar to a money market fund. There are a couple of differences. The major difference is going to be safety. So money market accounts at banks and credit unions are covered by the federal deposit insurance, keeping in mind that money market funds aren't. So if you lose a bunch of money in a money market account, you do get that money back, but if you lose all that money in a money market fund, you're not going to get it back. That money is just kind of gone. You can also have a savings bond. So bonds and certificates of deposits are going to be a little bit similar, but bonds are much, much more complicated. And I'm not going to go into detail about every single different type of saving bond that is out there. There is a Series EE bond. Series EE are probably one of the most common bonds that you're going to run into. They can be purchased for any amount greater than $25, and you can purchase them online at face value. So for example, you pay $50 for a $50 bond. So an EE bond is going to increase in value as interest accrues monthly. Kind of like with a CD, if you decide to cash in that bond a little bit early, you do get a penalty for it. So I have up here, if you redeem the bonds before 5 years, you forfeit the last 3 months of interest. After 5 years, you aren't really penalized. So again, you kind of get that security of you are going to get money, or you are going to get your initial deposit back as plus some interest. It's not money you really have to be working for, but it's not money that you really have in liquidity. It's not something that you can sort of easily get. You do have a Series I bond that has an interest rate. I'm sorry, I just realized that bonds is capitalized right there, and I'm not 100% sure why that is. That's very interesting. So a Series I bond has an interest rate based on 2 components. So number 1, a fixed rate for the life of the bond, and number 2, an inflation rate that changes twice a year. So a person may purchase up to $10,000 worth of electronic saving bonds every year, so both EE and I bonds in a year. So up to $5,000 of that paper series bonds may be purchased each year, but only with your tax refund. Thus, a person may purchase up to $25,000 in savings bonds every year. So bonds can get really, really complicated. I recommend that if you're interested in something like a bond, you just kind of go with a CD because they're a lot simpler. Taxes are going to be a lot simpler, and you don't sort of have to dig through between, which kind of series bond you want and for how long, and et cetera, et cetera. But they are certainly out there if you're interested and you want to check them out. So when you are evaluating your different savings plans, whether you want a savings account at a bank, ACD, some other type of savings bond, maybe an EE series, you're going to want to consider all these different factors. So for example, a rate of return. So how much money are you going to make? So in an example CD that I just went over in slide 15, after 5 years, you made $2,167. Maybe that seems worth it to you, and you absolutely want to go with that. But maybe that rate of return seems a little bit low, and you kind of want to go with something else, maybe a Series EE bond. You're also going to want to consider things like inflation. So higher consumer prices will result in lower buying power for the bond. Think about taxes. So a lot of times when you collect money on a bond, you made money on it. you are going to have to pay taxes on. The federal government is going to say that's income and we want our fair share. You also want to consider liquidity. How easily can you withdraw that money in that bond or that CD when you need it? So, for example, you fall and you break your leg and you have that $5,000 medical bill. What are you going to do about that? You also want to look about safety. So maybe is your bond going to be insured by the FDIC, because not every single bond will. And if the federal government goes bankrupt or your bank fails, are you going to get that money back? You also want to consider things like restrictions and fees. What kind of transaction fees are there? What kind of penalties are there for early withdrawing, et cetera, et cetera. So your rate of return or your yield is a percentage increase in the value of your savings from earned interest. So for example, if you put $100 in a savings account and you earn $3 after a year, your rate of return is going to be 3%. So that's $3 that you did not have to work for at all. That $3 was just given to you. It just appeared in your account one day. It's like magic. You didn't have to go to a job. You didn't have to work. It's just sort of a magic $3. Compounding interest, or just compounding, is going to refer to interest that is earned on previously earned interest. If you guys think back to time value of money, this is sort of the very, very basic aspect of it. The idea that you earn interest on your interest, your money is going to be worth more in the future than it is now. So interest is added onto your savings, and the next interest amount is computed on the new balance. So for example, you started out with that $100 over here. So let's see, so you got that $100, you got that $3 interest rate, so now we add that $3. Now you have $103 in your account. Yay, having $103 in your account. So now, if your interest rate is still at 3%, can't see my cursor, there it is. If your interest rate is still at 3%, now we're going to take that 3%, and instead of adding it to the 100, we're going to calculate that based off of 103. Compounding interest is always something you want to go for if your bank or other financial institution offers it, because the more an interest compounds, the more money that you're going to make. And then your APY, your annual percentage yield, is the percentage rate expressing the total number of interest that would be received on a $100 deposit based on the annual rate and frequency of a compounding for a 365-day period. I have the formula for interest, or I'm sorry, for your annual percentage rate, your annual percentage yield over here. It's pretty straightforward. I'm not going to get into a whole bunch about that, and I don't think you guys really need to know about that at this stage either. So very last slide, so we're almost done. Inflation. So inflation is, so I have it here, the rate of return you earn on your savings should be compared with the inflation rate. So the idea is that when consumer prices start rising, that's an example of inflation. If you guys have like parents or grandparents or great-grandparents and they say things like, oh, back when I was your age, I could go to the grocery store and I could get a gallon of milk and a loaf of bread for 10 cents. You know, now you can't really get anything for 10 cents. That's kind of an example of inflation. And you're going to want to keep inflation in mind in perspective of your rate of return. So, for example, so I have it here. At a time when the inflation rate was over 10%, people with money in savings account earning 5 or 6% were experiencing a loss in buying power. So, for example, let's say you bought a bond and your bond grew 10%. So you started out with $1,000 and you ended up with $1,100. But inflation sort of increased more than 10%. Well, you didn't really help your situation. There's a little bit of a loss in buying power. So you're going to want to keep an eye on inflation rates, and we'll talk a little bit more about inflation again later on in this course. So just keeping in mind, kind of summarizing everything that we've talked about, different financial institutions are going to offer different services, and when you're signing on them, consider what your opportunity costs are, what your trade-offs are, what services that they offer, and what type of institution you think might be best, if it's a commercial bank, if it's a credit union, a mutual savings bank, preferably not a payday loan center or a rent-to-own center, because that can be a big mistake. Also think about the Federal Deposit Insurance Corporation, FDIC. Is your money going to be insured or is it not going to be insured? And kind of where you think your money is going to be the safest. So this is it. You're done. On Canvas, if you guys go under the banking module where you found the link to this video on YouTube, underneath that should be a link to a Google form. If you guys just go on there and please fill it out very, very quickly, it's going to factor in as your course attendance, and there's also a question on there asking how you guys felt about this video. So if you guys didn't like this, if you found that this was really frustrating, it just wasn't for you, please let me know on that. And if you have any other ideas about what we can kind of do in the future, please let me know. Stay healthy, stay safe out there, you guys. Make sure you practice your social distancing, stay updated on UNCC, and I'll sort of let you guys know more information as I become aware of it. Bye.